In Chapter 3, we provide a review of professional ethics. The primary focus of this chapter is the AICPA Code of Professional Conduct. The value of ethics in any profession is important. It's especially important to CPAs. Our primary responsibility is to serve the public. We're providing an objective opinion of financial statements, and people use these financial statements to make decisions related to their investments. The standards that have been established by the AICPA serve two purposes. The first purpose is that the standards and the application of these standards increases the confidence the public has in CPAs. In addition, if we consider what the CPA offers as a product is attestation and assurance services, the credibility and the value of this product increases as we are able to validate that we are providing these services with a high level of professionalism and professional conduct. We will go directly into the AICPA webpage to explore these concepts. But before we do this, I want to make sure that we understand the structure of what we're looking at. The structure starts with principles, the basic principles that provide a framework for the guidance. The next relates to specific rules of professional conduct. We'll go through a number of these. And then finally, we'll provide some guidance specifically related to interpretation. The guidance provided for the professional conduct depends upon where you are in your professional career. Perhaps you are a CPA or a member in public practice where you are issuing audited financial statements. You may be a member in business. Perhaps you are working as a CFO. The final category includes individuals that are no longer working. Perhaps these individuals are retired but still maintain their membership as a CPA and an AICPA membership. We have now navigated to the AICPA Code of Professional Conduct webpage. You will need to register as a AICPA member. In this, there's no cost for this. However, I also recommend that you explore the student options. I think you will find the student membership as being extremely valuable to you. We have the Code of Professional Conduct. You notice that we can navigate to the table of content. As we had talked about earlier, there are three categories: members in public practice, you're working in a CPA firm; members in business, you're working as a controller; other members, you're no longer working in the profession, however, you are maintaining your membership in the AICPA. As we navigate through this, what we're going to primarily focus on relates to members in public practice. So if we click the link here, what we're going to identify are specific elements of the Code of Professional Conduct. So the Code of Professional Conduct includes integrity, independence. You go to one of these as an example of the acts of discreditability. You notice that it identifies what the discreditable act rule is, and then interpretation. We're going to go through specific areas in the next couple of slides, but I wanted to introduce you to this page. I strongly encourage you to use this information to gain an in-depth understanding of what the Code of Professional Conduct is and how it relates to you as a forthcoming CPA. We'll spend a few minutes talking about the Code of Professional Conduct as it relates to independence. Now again, what we're focusing on is independence from the perspective of an auditor conducting an audit. You notice that there is independence, actual independence, as well as independence in appearance. If we're conducting an audit of a financial statement, both are required. Let's spend some time talking about events that might impair our independence. If there's litigation between the client and the CPA firm, our independence is impaired. The CPA is not able to promote the client's securities as part of an IPO offering. If a spouse holds a key position with a client, this would impair independence. The financial self-interest of a CPA creates an impairment of independence if the CPA owns stock in the client firm. The CPA may lose independence if he or she participates in management, and if the client pressures the auditor to reduce audit procedures, This is another example of an impairment to independence. While the firm needs to be independent of the client, not everyone within the firm must maintain independence. Those that need to remain independent are what we call covered members. This includes staff working on the engagement, any individual within the firm that may have influence over the engagement, and partners within the firm, as well as the public accounting firm itself and the employee benefit program. Continuing with this discussion, no partner or professional employee within the firm may own more than 5% of the client's outstanding shares. No partner or professional employee of the firm may be a director, officer, employee, promoter, trustee, or etc. of the client. All direct financial interest is prohibited, and material indirect interest is prohibited. An example of an indirect interest is if you own a mutual fund and the mutual fund invests in the client, that is an indirect interest. And the indirect interest is only prohibited if it is material to your overall investment. The last thing relates to gifts. Many organizations actually prohibit accepting gifts from the client because of the potential, either real or perceived, as an impairment to independence. The rules that we discussed related to covered members include the immediate family of the covered members. The immediate family includes spouse, spousal equivalent, as well as dependent. The only exception to this would be that if the spouse works for the client but does not work in a key position within the organization. The second category includes close relatives. Close relatives include siblings or non-dependent children. The key issue related to this is these individuals should not have a key position within the organization or have a material financial interest that you are aware of. The final category that relates to a threat to our independence is other relatives. Now, the threshold of concern would be if a reasonable person aware of all relevant facts related to the situation, whether their material interest or their position within the firm, would this reasonable person conclude there is an unacceptable threat to independence? Let's talk briefly about the discreditable rule and how this applies to the auditor. Generally speaking, this is going to come into play if we have a client that has not paid their client bill. Now, the first thing is we cannot withhold documents that the client has prepared. There's certain documents that we can withhold if in fact their fees have not been paid. And then finally, CPA working papers are the property of the CPA firm and should not be provided to the client unless required by law. The final rules that I want to talk about just very briefly relates to commission, referral fees, and advertising. We cannot, for a contingent fee, accept an engagement. For example, we cannot accept a contingent fee based upon an outcome of the audit. We are able to accept commissions, however, these must be disclosed to the client. And finally, the advertising rule is such that we are able to advertise as long as it's neither false nor misleading. In this video, we did not go through every rule of the AICPA, but the intent was to provide some guidance as well as some direction specifically at the AICPA site so that you may be able to review these rules. So I thank you very much for your time, and I'm looking forward to our next discussion.